best way to protect the purchasing power of money is in equities. One of the fallacies that people unfortunately fall prey to is they think after a market decline, they want to reduce risk, get away from the financial headlines, just concentrate on the longer term.
Hi, I'm James Conner, and welcome to Speak Up on Wealthion. I am filling in for Anthony Scaramucci, and Anthony is currently in Jackson Hole, Wyoming at the SALT Blockchain Symposium, and he will be back here next week. My guest today is Andrew Parrillo. He's an institutional investor and an author. His most recent book is called Beat the Wealth Management Hustle. Andrew, thank you very much for joining us today. How are things in Virginia?
Great, thanks. Pleasure to be here.
You have worked in the wealth management industry for many years, and this industry has gone through so many changes just here in the last 5 years, ever since the pandemic. And a lot of people are taking investing into their own hands. And according to a recent study I just read, more than 50% of Americans are now self-trading or self-investing. And you have written a book on this very topic of self-investing. And once again, the book is called Beat the Wealth Management Hustle. Why don't we just start with a brief overview of your book, and what was the catalyst for writing it?
Well, the catalyst for writing it was that I was at a holiday party in December 22, and I introduced myself to people. And I didn't know anybody. I was a guest of somebody in another town. And it was a charitable organization, local charitable organization. And anyway, so I introduced myself, and I retired. I have 3 sons, 3 grandchildren, retired from the investment business a few years earlier. And I immediately, and that was December of 22. So the market was down, 15, 20%, depending on where you were in that year. And they immediately started asking me what they should do with their portfolios. So I politely, deferred to their advisor. I said, well, I'm an advisor. You should ask your advisor. And because I don't, give casual advice, and I'm not licensed at the time. I was not anyway, and I would not give casual advice at a party on investing. But anyway, and then they persisted with questions, and then it occurred to me that I asked friends of mine after that, a dozen people, who had advisors, whom I knew had advisors. I said, "Do you know how much you pay your advisor?" And every one of them said no. I said, well, that's, maybe you should ask. You should do more than just ask that, so you should ask some other questions, but it's up to you. And so that's really what moved me to write this book, because it was clear we're not, as an institutional investor, there's a structured, disciplined, although fairly simple approach that institutions take that generally involve a series of pretty common sense due diligence questions and interviews and evaluations. And so it occurred to me that individuals aren't doing that, and perhaps they should, because they don't know how much they're paying in fees. The other thing that I found that individuals didn't really have an appreciation for it is compound interest, and what is a fee? What does it amount to? And so they weren't asking any of the questions, and so they didn't really know what they were paying on this asset-based, and they were all paying on an asset-based fee arrangement, which, look, I started the business right around ERISA. So that's really when the institutional investment industry started. And that was in the early 70s. So, and they've had, asset-based fees ever since. Now they've been coming down, and asset managers, so-called wealth managers, are providing more planning services, I gather, according to studies I've read. But the industry has over $1 trillion, $100 trillion. And, even if the fee is 0.5%, that's 500, that's a lot of money. And I'm not sure that people understand what value they're receiving for the fees that they're paying. So that's really what moved me to write the book.
And when you talk about the fees, so you're suggesting that if you pay 0.5% or 1%, you're paying way too much.
It really depends. It depends on whether or not the advisor is adding value. And there's a fairly easy way to determine that retrospectively, of course. Prospectively, it's a little harder. You have to do it on, based on the managers. Do they have structural advantages? What are their competitive advantages? How do they add value? Simple questions that customers should ask, but probably don't. At least in my experience, they don't. But institutions do. So it's just saying, yeah, you might be getting value for whatever fees you're paying. You could be paying more than 1%. Many people do. And and you could be receiving a lot more value than that. And, but you get what you pay for.
Right. And to your point, you might be paying 1% for this financial advisor to manage your money, and he's sitting there doing nothing. Like maybe he makes an investment on January the 1st, and come December the 31st, he really did nothing, and he still collects 1% regardless of what activity is going on inside the account. Is that correct?
Yeah, that's absolutely right. And, to me, and again, getting back to the way institutions look at investing, to me, investing is it's an assessment of the future. Okay, you've made a time preference decision to invest your money, and presumably it's for a long enough term to be able to accept the risk that investing involves, depending on the return you want to make. And we can get into that too. How do the advisors determine a client's investment objectives in tolerance for risk, and how will they know when that risk tolerance has been exceeded? And then what kind of strategy approach do they set? Because let's face it, the most important thing advisors can do is let the client tell them and determine what their preferences are for risk and return, and do so in a way and the way I approach it is based on Kahneman's prospect theory, which is a series of iterative questions that people answer. So the client drives the process. So it doesn't be, I don't make subjective determinations about, well, you're a growth investor, or you're an aggressive, the fact is that half the people under 30 are not aggressive investors, and half the people over 70 are not conservative investors. That's just a fact. So, doing it on an objective basis is really important. And then determining an investment policy strategy is super important, because it imposes a discipline on people. And then, obviously, I shouldn't say obviously, but what I think is the way institutions look at it is they look at projections of likely future returns based on past returns. And is that viable? Well, we can get into that. But yes, I believe it is. And it's all, to me, behavioral finance is really the center of this question. That's my approach. So what do advisors do for their money? The most important thing they do is to set the advice. Now, do they have to make a lot of changes? Well, look, if they're traders, yes, they're making changes on a fairly frequent basis. But most investors that we're talking about, that have, some longer term funds are, setting it and forgetting it. What's Warren Buffett's favorite holding period? Forever. And that's really where I'm coming from. And by the way, at my firm, I also had a multi-strategy hedge fund of funds. So I did a lot of hedge fund evaluation for consulting clients that I had, I had endowment clients and family offices as clients. But it's possible to find skillful managers, but it's not easy. And the one thing you can control with certainty is the expenses that you pay for investing. And people should understand what that really means. And so what I'm advocating is nothing different from what Warren Buffett and Jack Bogle advocated, the late Jack Bogle advocated for years. And that is, keep it simple and stay focused on the long term.
So if you don't think an investor should be paying a percentage of assets under management, what should they be paying?
Well, I think they should. Here's the thing. People know what they pay their lawyer. They know what they pay their CPA. But again, ask people with advisors, what do they pay their advisor? Most people they don't know. Well, it might be 1%. I'm not sure. I'm not really sure. They don't really know what that amounts to. Oh, it's 1%. Yeah, that doesn't really mean. The thing is, they don't understand compounding. And that 1%, say on $500,000 for 20 years, if the advisor generates a gross of 7, which is a typical target return for longer term investors. Obviously, you want to make more than that, but let's just say 7. And they're charging a point. That's a 6% per annum net return. Well, the difference over 20 years on $500,000 is $331,000. So they're basically buying their advisor a new boat every 20 years. And do they know that? If they know it, great. If the advisor's adding value, I'm all in. That's what I did. I charged based on assets under management. But I'm saying that the average person doesn't need to do that. They need to have an objectively determined strategy and risk profile and plan, and they don't need to do anything. Most advisors, when the market back, a couple of weeks ago, we had a big sell-off. So people were probably rightly concerned, what's going on? And I would almost guarantee you that the vast majority of advisors simply said to their clients, not to worry, this too will pass. Don't make any changes based on this. One of the fallacies that people unfortunately fall prey to is they think after a market decline or in the course of a market decline, they want to reduce risk. Well, gosh, I just lost 20%. I want to reduce my risk. I'm going to sell. Well, that's your money. You can sell. And we all know that at least in our lifetimes, the market has recovered. And it probably will, but it certainly has. And so reducing risk after a 20 or 30% loss actually could be increasing your risk. It could be increasing your risk of not attaining your objectives in the longer term. Because once people sell, it's unlikely that they're going to come back right back in, or that they'll get back in a lower value. Maybe they may, but the market timing is the probability of doing so successfully is really quite low. And it's not a process that most people should engage in. And that's what I go through in the book, as well as the market history.
So that's a very interesting backstory on what caused you to write the book. Mel, why don't we go into some of the underlying themes of the book?
Yeah, well, the underlying theme is that the best way to protect the purchasing power of money, which has been eroded significantly over almost any interval, even when inflation was relatively benign for the decade or so following the great financial crisis, is in equities. And it's hard. You can't do it in savings accounts. After tax and after inflation, you're not going to be able to preserve your purchasing power with any certainty doing that with savings accounts. There are other ways to invest, certainly. But to me, equities are the highest probability liquid vehicle that people can use, that is a transparent vehicle. That also, by the way, one of the things that I didn't say, and I should say, is I've been around the business for a long time. And I remember when there were commissions on stock trades that were pretty significant. And I also remember, much higher fees on almost everything. And now people with relatively small amounts of money can access services from the major firms for no fees, and they should do so. But just not unlike what we experienced with Amazon in the last 20 years or so, or 25 years, where we have a lot of value we get great value from Amazon and people use it and it's popular. Well, we can kind of do the same thing when we invest. We don't have to pay very much money to get access to perfectly viable vehicles. And you can suit whatever risk profile you may have with ETFs. And now there are some more, fancier programs that some of the firms have that are tax managed, separate accounts and so forth, that have relatively low minimums in the neighborhood of 100,000 or so. And some are higher, but anyway, and that's getting more popular. But the point is, because taxes matter, which is one of the reasons why you don't want to be having high turnover in your portfolio, and we can get into tax efficiency as well. So really what I would advocate to people is to have a broad equity index that is in proportion to the risk that you are willing to assume. And that's done on a 6-month projection with 95% certainty, probability, I should say. And basically testing people to say, okay, this is the range of returns that are likely with a 95% probability over the next 6 months. Can you live with that? And it's done around a dollar value of their portfolio. So it's objectively determined, and we can get a little bit more into the analysis itself, but it's something that's a guidepost for people against which they can measure their own progress, both and to avoid that which is the biggest risk in investing, and that is making an emotionally driven response either to participate in an up market or to try to avoid a down market.
No, that is so true, because human emotion drives everything in the financial markets and so many other aspects of our lives. But before we talk or do a deeper dive on emotions, I want to first ask you about some of the traps that can be found in wealth management. You've already laid out a big one, that is excessive fees. But what are some of the other traps that investors should be aware of when they deal with a financial advisor?
Yeah, I'm not sure that there are any traps. I think that the book actually just advocates disclosure and transparency. People now the SEC happens to say that all advisory fees must be negotiable. Now, how many advisors have told their clients that their fees are negotiable? They may not lower them, but they have to. But the client should know that they can negotiate the fees. And if you don't ask, you don't get. But I could almost guarantee you that if people knew to ask, they would get lower fees, and they could quantify that lower fee. Just ask the advisor, what does it mean? What's the difference between the fee that you're charging me and this lower fee? And let's see if it's what is that? What is that worth? And so it's just here's one of the people I met in the course of my research before I wrote the book, or in the process of writing a book, was a very successful residential real estate broker in a fairly high-end market. And I asked her, how much she paid. I don't know how much I paid my advisor. He's really good, though. I said, that's great. I said, well, do you ever think about asking him how? Oh, no, it would be confrontational to ask him how much he charged in fees. Now, this is a real estate broker whose business depends on negotiating prices. But her mindset was that, oh, no, I don't want to confront my advisor with a question like, how much is he charging me? And of course, I don't go any further than that with anybody. I say, okay, that's your choice. But do people realize that when they're paying an advisor, they're paying the advisor to take risk with their money? What? But that's what's happening. And I'm not sure the industry has done a really good job. And I'm not sure they're setting a trap for anybody, but they're very persuasive. And people, they don't really say how they add value. And oh, by the way, if they did add value over an index return, over a what professional might view as a naive portfolio of a broad equity market index, if they could do that, they'd probably be advertising that. And I'm not sure that any do. Some may. I mean, I know in the institutional world that happens regularly. People have net performance, and analyze it all different ways. But the typical retail, so-called and that's another thing, a trap. Okay. The SEC distinguishes between retail and institutional investors. You know that. And that I think institutional investors have 50 million or more. But the reality is that most individuals with not very much money at all can invest at the same expense ratios as institutions. That's what competition has done. So we have, Amazon has been very hard at work in the investment, in the mutual fund world for the last, 10 or 15 years in particular, lowering fees and competing with each other. But the wealth advisors haven't lowered their fees. Now, maybe they've added some bells and whistles to their services. We're going to do some financial planning and tax planning, and that's good, and legacy planning, and maybe we'll refer you to an insurance, broker or something for your succession planning in a business. And you certainly should be talking to a lawyer. They're all the basic things. But once you get beyond the basics, they really should just be giving investment advice. And that's where the value, if they add value, that's where the value would be. So I'm not sure that they do, but they don't. It's almost like it's something you don't talk about. Yeah. It's the elephant in the room that people don't talk about. The wealth managers don't talk about.
No, you raise a very good point, because it is all about managing risk, and that's why you pay this management fee. But the other element that comes with that too is performance. And if you take a year like 2023, if you remember, we started the year off, everybody in the world said we were going into a severe recession, and 2023 came and went. We never saw a recession. The S&P was up 25%, the NASDAQ was up 50%, And I would dare say there was not one money manager in the world who came anywhere close to beating the S&P, never mind the NASDAQ.
Well, look, we know how the S&P has skewed over the last decade plus, okay, where five of the issues represent something like well over a third of the value of market capitalization of the S&P. So it's been the big, the Magnificent Seven, so-called big tech companies, and meta cap tech companies, who, by the way, their earnings have justified the performance. Now, where does that leave us? And I don't want to get into the go down the rabbit hole of what's the valuation, how does it compare to history and so forth. But, one interesting point that I try to make throughout the book is to try to keep things in context, in historical context. So recently we had an unemployment report a couple of weeks ago that concerned people. The market got sold off because the unemployment rate ticked above 4%. Well, guess what? For 50 years, the average unemployment rate's been 6.2%. Through most of my career, a 4% unemployment rate would have been full employment and nirvana. Okay. And as you point out, since 22, at least, people have been calling for a recession. Well, is one going to happen? Yeah, household survey of employment is getting a little soft, it's getting a little squishy. But, most people, they have to get away from the financial headlines and, just concentrate on the longer term. Is something fundamentally changing? Do we have excesses in the economy that would cause, a September 2008 type failure of a system? Do we have systemic pressures? I would say the biggest pressure we have is government debt and the diminishing value of the dollar, but it's not like it's going to crash the market tomorrow. Over time, the only way to keep whole is, as I've already said, is to take some risk, and that's primarily with equities. Yes, could you do it with gold? Yes, you could do it with gold. Mm-hmm. Could you do it with Bitcoin? Well, that's something about which I actually know a great deal. And I will just say, just briefly on that subject, it is the only commodity that has a programmed fixed rate of inflation and ultimately a fixed supply, the only commodity. And so is there value in that? Well, a lot of people think there is. Is it speculative? Yes, it is speculative. But it's also been an amazingly productive asymmetrical allocation at a very small level for clients for years now. And will it be in the future? I don't know. Would I recommend it to anybody? It would really depend upon a total portfolio approach. But it's not some it's not some fraudulent thing. Okay, but by the way, if one put 1 or 2% in it, that would not be speculative to me. And that's not necessarily advice to put 1 or 2% into anything. But if you think about it, the stock market could fluctuate, on a daily basis, a point or more every day. Does that make it speculative? Well, maybe to some people it is, but I think not if you look at it over a longer haul.
Regardless of what you think of cryptocurrencies or Bitcoin specifically, nobody can deny the massive outperformance of it in recent years. And I only wish that I got involved a few years ago. But anyhow, so there's one thing I do want to ask you about when it comes to managing your own money. There's a number of risks, and one of which is volatility. And you touched on this earlier. We had that pullback in the first week of August. For whatever reason, maybe it was the higher unemployment number, which rose to 4.3%. But what would you suggest to investors who are managing their own money, and how do they deal with these pullbacks in the market? Because the one we saw in the first week of August was mild. When you look at, say, the COVID crash of 2020 or the Great Recession that we saw in 08, 09, those are significant pullbacks. What would you tell investors who are managing their own money?
Yeah, let's just think about the COVID scare. Okay, in a month, in roughly 30 days, the market went down 35% each drop. Of course, we know what happened. It did snap right back. What was the right thing to do then? Well, to me, it would just be to hold, and that would be and by the way, that sell-off back, a few weeks ago now, I guess it was 3 weeks ago, was in part because of the Japanese central bank and so forth, and that ignited some concerns about carry trades and such, which the average person couldn't possibly make sense of. Okay, and even professionals have a hard time making sense of that one. But is that worth really taking your assets out of a strategy because of something that happens that you don't even understand? And I would say probably not. I wouldn't. And so what would I do during intervals like that is I would just say to people, focus on the long term. And unless there's something that's structurally changing in our system, whether it's taxation or monetary policy. And by the way, on monetary policy, to me, the Fed has been very transparent. They've said exactly what they're going to do since March of 22, almost every week ago. Well, back in 22, 23, the governors were coming out almost every week saying, kind of reinforcing their message. And they did exactly what they said. What will they do in the next couple of months? I don't know. There's some softening. Inflation has come down. But again, inflation, it spiked because of supply chain problems during COVID. But I remember when inflation was in the teens and where interest rates were in the teens back in late 70s, early 80s, and they peaked in 1981 at 15% on 20-year treasuries, almost 16%, or 10-year treasuries, and also longer treasuries. But so kind of put things in context. It's hard to find excesses now. So are there systemic problems? The government debt is back to a level relative to GDP where it was in World War II. And people recognize that and see that. As long as people have confidence in our government, in our economy, and in our monetary policy, then they don't have to be making changes in their portfolio, it seems to me.
So you're not concerned about these debt levels, even though it's at 125% of GDP?
I am concerned about it, yes. And I think we should do something about it because there are structural imbalances that are not being addressed in our democracy. And that's one of the problems is that, the politicians pretty obviously want to make people happy. And so they want to do things that are not fiscally sound, frankly. And there can be longer term solutions to that problem. To me, I have not seen a program yet that politicians today are talking about that will solve the structural deficit problem.
Yeah.
How do I discount that? Well, one of the ways I discount it, quite frankly, is by having a position in Bitcoin.
And what about gold?
My experience with gold is back in the late 70s. I had a client at the bank whose family owned one of the two precious metals refining. They were licensed to deal with precious metals back in the 70s when it was, gold was not trading freely back then. And this owner, he sold his entire inventory of gold and silver in January of 1980 when people were lined up selling their flatware at silversmiths, jewelry stores around the country. And gold was, I think, at $850 in real dollars at that time. I don't know what the inflation adjusted price of gold is right now. It's what is it, $2,400, $2,500. So it has gone up recently, but the performance of gold hasn't been great. It could be part of a portfolio for sure. I understand the emotional attachment to gold. I get that. But from a performance standpoint, it's kind of, okay. It's okay. I'm not going to argue against a small allocation to gold, but, it's not something I'm going to be advocating.
Andrew, I want to get your thoughts on where the wealth management industry is going in the next 5+ years. And I mentioned at the onset that 50% of Americans have do-it-yourself trading account, or they're looking after their own investments. And do you think that number is going to keep growing? And when I ask about this, I guess I'm looking at, especially during COVID, and I'm thinking about Robinhood and the number of people that got on Robinhood and just started day trading. And I know that was a lot of fast money, a lot of people just sitting at home. But I think the last thing I read, Robinhood has 25 million accounts and $130 billion in AUM. Do you think this trend is going to keep going where people are managing their own financial affairs and less money is going to be allocated toward financial advisors?
Yeah, I do. Now, what's their risk profile? Will it be day traders? Will they be, will they be buying individual securities, or will they be buying, just a broader diversified ETFs? I think that the latter is probably what they're going to do. Yes, there's a cohort that wants to take the risk and that, is excited by the opportunity to make lots of money really fast. That's a process that is hard to sustain, and is fraught with danger, because people get a little over their skis on that stuff. But look, if you allocate the right proportion of your portfolio to the riskier strategies, that's fine. Yeah, sure. Do I think it's going to continue where people do their own money management? Yes, I do. And what can I say? I just think this so-called wealth management, to me, health is wealth. It's not money. But anyway, what they want to call it wealth management, to me, it's investment management. But anyway, and I talk about that in the book. But yes, people will continue to do it. And why will they do it? Because they can control the expenses. And they've seen enough studies, and they've listened to, Warren Buffett enough and Vanguard enough and so forth, to realize that fees matter, and they can save fees for sure. They don't know what the outcome of their portfolio is going to be, but they know the outcome of their fee account will be, and it'll be that they won't pay any fees to speak of. And and who doesn't want to have lower fees?
No, definitely. And that's one of the reasons why so many people gravitated toward the Robinhood app, right? And even when you look at that, the other thing that really stands out to me too, when I look at that app, it's like gamification of trading. And even with these short dated options that people are trading now, like that's just exploded in the last 5 years. It's like everything that's a game now. It's no longer investing.
Well, that's interesting you say that, because I've been around for a while and I've seen different fads. In investing, there are fashions in investing. Okay. It's really a fashion industry. Something will be in and out of fashion. And yes, there will be intervals where people want to make money really fast, and that's one way to do it when it's going in their direction. As long as the one thing I would caution people on, though, is be really careful with short trading, short sales, because there's an infinite the risk, the profile on that is asymmetrical. You can, in the long you can only go to zero, in a short you can go to infinite losses, theoretically. And so people should know that. So if they're going to be shorting, they have to be very disciplined about covering their shorts. But that's about all I can say on that short-term trading stuff. Because I've never been interested in looking at hedge funds. The most successful hedge funds that I've seen, and there are some savants who are really good traders, but they're limited, and the access to those pools of capital is fairly limited. Or indeed it's closed in a lot of cases. Yeah. But fundamental investing on the long side has made a ton of money for people, and that's where hedge funds really have made their money, on the long side, not so much shorting. And what can I say? Now, there are some strategies in hedging, the capital structure arbitrage and so forth, that are interesting, but the risk profile is very different, and it's not for everybody. But I think the average, if I could, the so-called retail client, I like to think of individuals as individuals, right? They really can invest like institutions. They don't have to pay a lot of fee. They can take the same approach as institutions take. They have access to most of the same things. I mean, for example, private equity has been a big buzzword, and I don't know where it stands right now. I know that there's not as much money going into it, but there are publicly traded major corporations whose business is private debt and private equity investing. And the performance, and that's not a bad proxy for private debt or private equity, it turns out. So you don't really have to tie your money up in a fund and be subject to capital calls and uncertain distribution times and so forth. You can buy these publicly traded companies that do that as a business, and they do it rather well, and it's reflected in at least so far it's been reflected in their stock price. Will that always be the case? Maybe not. There are fashions in the industry that come and go. And I just think people have to, yes, there are opportunities to access that are especially ripe at certain points in time with at the margin, but not for the whole portfolio.
When you talked about the dangers of short selling, I couldn't help but think of GameStop. Did you see that movie called Dumb Money?
No, I mean,
Oh, I would highly suggest you check it out. Okay, it's all about Keith Gill or Roaring Kitty and the GameStop story, and it's so interesting because it's all about one moment in time from, I guess, 2020 to 2022, and what happened to a couple of these hedge funds that tried to short GameStop. They got their faces ripped off. But
well, but people's perception is not always. In fact, it's often not connected to facts and fundamental facts and reality. It just isn't. It's like, oh yeah, and so look, Wall Street and Anthony's fond of saying this. Look, Wall Street is a magnificent sales machine. Wall Street, and I guess what I would say to anybody, if Wall Street's selling it, should I be buying it? I mean, that sounds perhaps cynical, but I think to me, it's just being circumspect.
So, Andrew, we have a number of questions that some of our viewers have submitted, and we're going to go through some of those questions right now. Why don't we just go through the first one? It's going to come up on the screen. So the first question, do you have any tips for staying informed about market trends without getting overwhelmed by too much information? And I think that's a great question from Stephanie, because we are just inundated with so much free information. How do you make sense of it all?
Well, I will say, and I don't know if I can use firm names, but there is a major firm, and there are probably several. I happen to look at one that publishes a monthly chart book guide to markets that has a variety of statistics that go back over longer intervals, like back 50 years, or sometimes more, sometimes only 20, but usually it's longer, like 50-year averages. And you can put these various items and variables, whether it's employment, inflation, profits, stock returns. In one interesting chart in this one of these books, and it's in a major firm, I probably shouldn't say the name, but if you just Google Guide to Markets, you might find it. But it has a really interesting chart that shows sentiment and subsequent 12-month returns on the S&P 500. And perhaps it wouldn't be surprising to you, but when sentiment has been negative, the subsequent 12-month returns have been way more than average. So,
we saw that in 23.
And we saw it in March of 2009. I mean, the news in early March of 2009 was getting worse by the day. And when did the market turn around? On March 9th, 2009, and it never looked back. And I think the S&P was like 660 or something. And it's got to over 5,000. So try to stay away from being influenced by short-term data points. Look at those data points relative to a longer-term horizon context.
So in other words, adopt a Warren Buffett-like strategy, get long and just stay long.
Yeah. Now, interest rates, we haven't talked about that. Interest rates are super important to everything. But again, it's really hard to, interest rates are fundamental to the prices of financial assets. And I would just say, I shouldn't be making predictions here about them, but we have to, basically fundamentally make some decision about them. How will they affect stock prices? Well, if you look back at the long-term history of stock prices, yes, you can look at interest rate increases and what happened to the market, and you can look at how interest rates affect valuations of equities, which is significant. But we also had kind of a trick that got played on everybody after the great financial crisis, where interest rates essentially went to zero. So there was financial repression, and in some countries, interest rates were negative, which is hard to get your head around, really. But so what it forced people into take risk. Well, what happened? We all know what happened with the stock market since that time. It's with the exception of that 30% decline in a month during COVID, it's done pretty well. Will it continue? No. We're going to have corrections in the market. So the most important thing you could do as an investor is understand your tolerance for risk before it is exceeded.
Great points. Okay, how about another question? And the question is, any thoughts on the role of alternative investments like real estate or cryptocurrencies in a self-managed portfolio? You touched on this earlier, but why don't you just say a few more words on it.
Yeah, well, I think that to the extent that the fundamentals of an alternative investment are attractive, yeah, sure. One of the alternative investments, yeah, that's a pretty broad subject actually, because it encompasses private equity, private debt, hedge funds of all stripes, commodities for sure, real estate for certain. What else? I might be leaving something out, but so you can access opportunities in those sectors through publicly traded ETFs. You might remember a few years ago, REITs were all the rage, and then they weren't. and, but people were chasing yield, yeah, you just have to be aware of the part of the cycle that a sector may be in by looking at the longer-term history of that particular sector and trying to avoid buying it, at the top. And speaking of that, just in general, there are studies that show that buying at market peaks has actually been relatively productive, but for 5-year intervals of holding period. But if your holding period is less than 5 years, or probably more frankly 10, you probably shouldn't be owning stocks.
Okay, how about another question, please? How can one stay disciplined during market downturns when it's so tempting to sell? And that's a great question.
Well, again, I'd go just again try to look at history and know what's happened historically, and that what is Warren Buffett says: be greedy when other people are fearful, and fearful when other people are greedy. Just try to keep that in mind, and that's pretty solid advice. It's tempting to want, as I said earlier, to say, I want to reduce my risk after the market goes down 10, 20 more percent. I want to reduce my risk, so I'm going to sell something. And what you're probably doing is you're probably increasing your risk of not achieving your longer term objectives, because the money that you use to sell, now maybe you're going to put it into something that goes counter to the equity market, which generally has been the bond market, but not always. As we saw in 22, bonds essentially crashed. And look, we had a 40-year bull market in bonds until August of 2020, and the 10-year was trading at 75 basis points. But so yeah, I would just say try to avoid emotional reactions, because you will get emotional. There's a familiar temptation to chase winners and to try to avoid declines. But I would just say chill out.
Okay, great comments. How about another question, please? If you could give one piece of advice to your younger self when you first started investing, what would it be? That's a great question from John. Thank you.
Dollar cost average every month. I think the simplest, the most competitive returns relate to some of the simplest, not simplistic, but simple solutions, which is buy a broader market index, do so dollar cost average, do some math on dollar cost averaging and see what happens. It's really quite amazing. You're buying more shares of stock at lower prices, when the market goes down. It's cool. So when it goes up, you should do the math on that, because it's just, and you can do that pretty easily. Thank goodness. Google the internet is great. Lots of calculators. But I would just say dollar cost average. That was the advice. Would be the advice. And people would be astonished at the compounding factor.
Yeah, so true. Sometimes it's easier said than done. And I think one of the issues, though, is, and this is kind of relating to what you said earlier, but we're bombarded with so much negativity on a daily basis. When the market pulled back a couple of weeks ago, excuse me, when the market pulled back a couple of weeks ago, if you watch the news, you think that's it. The world's coming to an end. You got to sell everything, right? But these are always opportunities. And I think the other interesting point too about Warren Buffett, he's in Omaha, Nebraska. He probably watches very little TV. He doesn't get caught up in all the hype. And when he does see a big break in the market, he sees it as an opportunity.
Well, he's done fundamental analysis on companies that interest him because of the characteristics that he seeks, which may not be the characteristics that other successful investors seek, frankly. He missed the entire tech boom. Well, he owns some Apple. Is that a technology company or a consumer product? I don't, you tell me. But so, he's a fabulous guy. I think he's a really wonderful investor, a great investor, and somebody who you should pay attention to for sure. But can I say, I think he's ready to, when the price is right, he'll buy it. When the value is there. Now, if you look at the difference between so-called value equities and growth equities, it's quite astonishing what the difference is. I mean, in the last 10 years, I think value equities are up half as much as growth equities, indices, that is. And I think that's about right. But I mean, it's not a little difference; it's a big difference, and that might even go back 20 years. And that's on the strength of the more recent growth performance. But there was a time when I first got in the business where value investing was all the rage in the 70s. Oh yeah, I mean, you had to be a value investor, and it was really interesting. And when I advised endowment funds, and one of the funds I had in the late 80s, early 90s had no information technology exposure at all. And as a consultant, I was looking for information technology experts and investors. And there weren't more than a handful in the entire country in 1990. At that point, there had been a crash in the tech sector that started in 83 when disk drive companies failed. And because they got overvalued and people got too excited and they crashed. So there was a 7-year bear market in tech. And I looked, and there just weren't any. Now, 10 years after that, by 2000, everybody was a tech investor. And now we know what happened in the dot-com crash, right? But so you have to understand that, yes, we can get to extremes. Are we at an extreme now with the big favorite so-called Magnificent Seven? I'm not so sure we are, because there are some fundamentally strong factors that influence the prospects of those companies. And they may change, but there's just try to keep things in perspective.
So, Andrew, we have time for one more question. Let's see what it is. What books or resources outside of your own do you recommend for someone looking to deepen their understanding of finance and investing? And that's from Dan in New York. Thanks, Dan.
Actually, probably one of the best, the late Daniel Kahneman, who passed away last year, won the Nobel Prize in economics as a psychologist. And he wrote a book, Thinking Fast and Thinking Slow. And I would encourage people to read that book. And that's the basis on which I, have used for, prospect theory, which is, again, how do you determine, people are 2.5 times more likely to avoid risk than they are to try to access gain. Okay. So so his book is is one of the books that I would highly recommend, is Thinking Fast, Thinking Slow.
And I have to mention one book that I've always enjoyed, and it's called Reminiscences of a Stock Operator. It was written over 100 years ago, and it was all loosely based on a well-known trader at that time. His name was Jesse Livermore. And one of the things I find interesting about that book is, in spite of the fact it was written over 100 years ago, and a lot of the rules and regulations have changed, the basic fundamentals of human emotion has not changed at all. And 1,000 years from now, it'll be the same thing driving the markets. It always comes down to greed and fear, right?
Yeah, that noise you might hear is my dog drinking water.
Oh, okay. Well, listen, this was a fascinating conversation, Andrew, and I want to thank you very much for spending time with us today. If somebody wants to follow you online or maybe read about your book or purchase your book, where can they go?
They can go to Amazon and just Google my name, Andrew Parrillo, Beat the Wealth Management Hustle. And the book actually has, on the back cover of the book, has the address of my website for my firm, which also has some tutorial information that we talked about, and the name of the firm is Victory Road Advisors. So it's victoryroad.com is the address. It's simple, one word.
Well, listen, thank you very much for making time with us today. I did enjoy it.
Thanks, Jimmy. Appreciate it.
Well, I hope you enjoyed that discussion. And if so, check out this one.